And we're back, episode 10 of ETH Call. And it's been an incredible week in the crypto space. Very unexpected, very excited. I'm sure most of you heard now the news coming out of a US based court that Ripple has won many aspects of their case against the SEC or the SEC's case against Ripple regarding XRP. So if you guys saw the news, we're going to break it down for you what it all means for the space. But effectively, the court said that XRP is not by default a security when it was sold and transacted with by random third parties. It was not a security. The only time it was a security was when Ripple Labs sold XRP to institutional insiders. So this is a very big deal for the crypto space and obviously very exciting. A lot of people in the industry have been saying for a long time that these assets aren't securities. And it seems like at least one court in the US agrees. And now this is sort of the precedent that we have. So, of course, it's not a binding ruling, it's not a law coming from Congress, but it is good news. And you're seeing, obviously, everyone in the media picking this up. You're seeing tokens outperform. Overall, everyone's just extremely excited. We're going to go through some of the key aspects of the ruling here in just a second. But Chandler, any quick thoughts you want to highlight?
One of the things I love about having a conversation with you on our weekly ETH call, Justin, is that we tend to cover topics that we have looked at before, and we've covered them over a couple of sessions. And this Ripple case is exactly one of those. And I distinctly remember us talking about this in a way where we were like, oh, we weren't actually so hopeful on the idea. We kind of, took an armchair pundit approach going, what would happen if it was a security? What would happen if it wasn't a security? And now we're finally at the day of the decision. And
Yeah.
I have to admit, no matter what the ruling was, I'm very glad it was in the favor of our industry. I'm just not glad this has been the Ripple team that got this. How many projects out there do we think are currently in a debate with the Securities and Exchange Commission that we would have rather had them be declared not a security? But a win is a win. And overall, I think it's a net positive.
This is the groundwork for everyone's case going forward. Everyone that received those Wells notices back several months ago, I think it was around ETH Denver, maybe in January, February, a ton of DeFi projects received Wells notices. Basically, that's a complaint from the SEC saying that we think this is a security. Obviously, that's simplifying things a bit, but this is like a huge case that they can now use and say, we have this precedent here. What we did was similar to XRP, different and probably better in many ways, but certainly not a security, which I think is really helpful. But before we do that, I do want to just do a quick rundown. I think a lot of viewers are going to be familiar with what the Howey test is. This is basically how the SEC determines if something is a security, right? And so there are 4 things that have to be met by the Howey test for an asset to be a security. So as you can see here, it's an investment of money in a common enterprise with the expectation of profit to be derived from the efforts of others. So simply put, someone's investing some amount of value into some shared organization. They're hoping to make money from it, and they're hoping to do that because they're investing in someone else's work and someone else's effort. And so the big sentence here, I think, from the court filing here, you can say I have the document pulled up, this is a direct quote. Having considered the economic reality of the programmatic sales, the court concludes that the undisputed record does not establish the third Howey prong. And the third Howey prong in this case is the expectation of profit. So this is really fascinating. For those that don't know, these programmatic sales, that's referring to actually transactions, I believe, on exclusively centralized exchanges. So on a decentralized exchange, perhaps you would have even more of an argument that this does not establish that third Howey prong. But these programmatic sales, that was really sort of the issue before. People were buying and selling and trading these assets and quote unquote investing on, say, Coinbase, Binance, wherever. But if the programmatic sales don't mean that we have a security here, that's extremely bullish our industry. So we saw Coinbase actually just relisted XRP yesterday as soon as the news broke, which is very bold and very interesting and exciting, and we'll see how it plays out. But clearly that's the law of the land as we have it now. That's what the judge decided, which is obviously incredibly exciting. And people across our industry are also very excited. So you can see Cameron Winklevoss here tweeting out that the sale of XRP on exchanges is not a security. This means that sales of all crypto on exchanges are not securities in the SEC, and Gary Gensler have no jurisdiction over them. this is a watershed moment that relegates the SEC to TradFi. I think this is sort of a big, bold take. We don't know if this is necessarily true yet. It doesn't mean that all sales on all exchanges are not securities. Certainly, that could change in the future, but right now it seems like this is the precedent we have to go off of. So the industry has been rallying. XRP is up, I think, close to 2x since the news broke out. Coinbase is, in the news again. Everyone's excited about Coinbase, and Coinbase is excited about what happened with this ruling too. And their stock has massively outperformed the market. So this is really interesting, actually. The day that Coinbase received its complaint from the SEC, the stock has since 2x'd since then. So we've seen like an 100% gain in Coinbase since the SEC actually brought those charges or sued Coinbase. And it really feels like the tides are turning. So it seems like there's a ton of demand from institutions and positive PR. And overall, I think our industry is just extremely happy about this. And then to cap all of this off, we're seeing even more bullish comments from very notable, very smart people that represent very big institutions like BlackRock. So I think we talked a bit about Larry Fink talking about Bitcoin as an international asset that sort of is an alternative to gold. He actually just this morning did another piece on CNBC where he talked a lot about cryptocurrency and said, blockchain is really important. And he also said, as you can see in this CoinDesk article, that they're talking to a lot of their gold investors or investors in the gold ETF. And they're asking about crypto, asking if it's a complement to a gold in the portfolio, an alternative, how it should play a part. And that's really why Larry Fink is doing this and trying to get this BTC ETF approved. So overall, very exciting times. I know I threw a lot at you guys there all at once, but it's really been a landmark week. We're seeing a lot of people saying this is like the start of a bull market. Tough to say. You never know. Who knows what would happen if a recession came, but we're certainly out of that dark period where it was just one bad thing after another with FTX, Binance, all of this stuff. So overall, very excited. I'm sure you are as well, Chandler, right?
Couldn't agree more. I mean, when you hit rock bottom and everything has just been not going your way, it's only a matter of time before there's a succession of good news that comes through. And this is exactly that. I'm seeing, I'm not necessarily also calling the bull signal, but I've been seeing a lot of that murmuring around. We've, the real kind of like speculators and kind of like more forward visionary thinkers that we've in our space has said the bull market started about 3-4 months ago. It's just these are now the signals that we're seeing as a result of that. I mean, things like getting an ETF set up, that takes a couple of months to kind of just get the application together. So there was a signal there from some of the insiders that we would have had early access to this. There are some other indicators from like the turning in the price. I don't know of any particular industry or any particular company that has a lawsuit against it from the SEC, which is so fundamental to its business, actually rally on the fact that the SEC is doing a bad thing. It's almost like a death sentence for any other financial services. And we're not seeing that. So I think this is just a testament to good business over time from the Coinbase side. I mean, we've been praising Coinbase quite a lot on this podcast, and they rightly deserve that. But the fact that the markets also think so and are kind of also reinforcing that sentiment, I think is a very strong indication for the powers that be that don't really want crypto to continue, to actually take a second look at that and realize that this industry is going to be a lot harder to dislodge.
Yeah, you bring up a lot of good points. It's almost like it feels to me like the market is sort of like sniffing out the truth. Like with Coinbase, the market is sort of saying that the SEC's complaint doesn't have teeth here, or if it does have teeth, it's like going to have a minor impact. And I also want to share CoinGecko here. Always fun to look at CoinGecko, but you're seeing like the market is, don't focus too much on BTC and ETH. They're up obviously, but the market is sort of repricing all of these tokens that the SEC alleged were securities in their complaint against Coinbase and Binance. So they complained that Cardano was a security, Solana was a security, and Matic, Polygon was as well, forcing actually Robinhood to take these assets off their platform as a result of that. And you're sort of seeing like in the last, 7 days since all of this news unfolded, the market has sort of repriced these assets and they're all up between like 20 or 30%. Obviously, Ripple is up the most here at 61% or so. But yeah, the market's sort of sniffing out the truth, which is really nice to see. There's a lot of chatter that the SEC is going to appeal this Ripple decision. It wouldn't surprise me if they did, right? It's a pretty big loss for them, and it basically means Congress has to set some legislation if the SEC doesn't win in an appeal. But that's 2 years away from what we're hearing from legal experts. And so this is going to be the precedent for a year, 2 years, who knows how long, until we get some legislation passed from Congress or until we get another ruling from a court. I also want to point out that, so I did some Googling, and the SEC's total budget for 2023, I believe, was $2.9 billion, which sounds like a lot of money on paper. But like, if you think about the Ripple fully diluted valuation, it's something like their market cap is 40 billion and their fully diluted valuation is 75 billion, right? So that's like Ripple Labs can dump 1 week's worth of XRP and come up with the entire budget of the SEC. And I've just got to imagine, like, they're pretty strained here, right? They don't have to worry about just crypto, but even in the crypto space, they're fighting Coinbase, they're fighting Binance, they're bringing actions, or they brought a settlement against Kraken, and then they're issuing Wells notices to all of these DeFi projects and investigating them and seeing if they're offering securities or selling securities. So I think the SEC is probably fairly stretched thin. I do think this is something they want to appeal and will appeal, but they don't have unlimited capital and they can't regulate away everything. So I think we'll see what happens, but I think this is bullish Congress legislation. I think something will get passed now. I think the SEC is probably going to have to push for that as opposed to just regulation by enforcement, but we'll see.
Tying into that topic, Justin, I actually have a question from you as an outsider from the US. One is, do you think that Gary's play here is on more of a selfish note and that he's actually using, as the rumors suggest, he's using his enforcement into crypto to get his way into a higher position with the powers that be? In this case, very specifically, Elizabeth Warren and the shenanigans around her dislike of crypto, if that's the way to put it. And then secondly, how much of the next set of elections do you think will be tied into policies that relate to crypto? I mean, in my mind, it's still a tiny industry, and maybe it's growing a little, every year in the US. But how much do you think having a very concrete and progressive crypto policy will actually be swaying voters for one party or the other?
So I don't know if Gary's taking sort of, there's that thesis or conspiracy theory that Gary Gensler is taking orders from Elizabeth Warren and sort of like the more left-leaning side of the Democrats. I don't know how much stock I hold into that. I mean, the SEC in some ways is directionally correct. Like, if we truly are being honest with ourselves, like when you buy the XRP token, it might not fit the Howey test legally, but just like common sense wise, it is you or me or whoever buys it investing in what Ripple Labs is doing. And so, like, to me, it's pretty clear there do need to be protections for investors, and like we do need legislation passed. And so I think it's pretty hard to make the case that Gary's like giving a best faith effort at this or a good faith effort at this, just because like we've seen a lot of PR that just doesn't make sense. We've seen sort of like gaslighting by the SEC, like when they brought that fake exchange in front of Congress and told them, like, look, this exchange registered with us. Why can't Coinbase? When they were,
Oh yeah, I remember that.
Fake.
That was a joke.
I don't think they're operating in good faith, but I think like I could see a world where the SEC tries to bring enforcement actions properly, because like you are investing money in something. So I don't know if there's a huge conspiracy going on. I will say though, like if you're not in the crypto space or you're not like in the weeds of a specific organization, most people here sort of have like a pretty decent amount of respect for our regulatory bodies. So like people outside of crypto don't really think about the SEC, right? And they actually have like a pretty good experience with how our financial services are regulated. Like it's very safe here to use banks and to invest your capital in the stock market. Like you sort of know you're getting these protections, and most people appreciate that. Just anecdotally, when I joined crypto in early 2020, someone I really respected was sort of onboarding me into this space and telling me how what the SEC was doing back, even in 2018 was, quote unquote unethical or wrong, or they didn't agree with it. And I remember just, not being a crypto native, just being shocked, like, well, like, why would the SEC do that? They're just here to help. And I think most people not in the weeds of our industry probably think that and give the SEC the benefit of the doubt. So I would keep that in mind. As far as how crypto plays into this election cycle, I think it's probably not a big issue, or a non-issue, I should say. A good portion of Americans have bought cryptocurrencies, but I don't think it's worth Democrats or Republicans really aligning to too much. We've seen some candidates preach it. Robert F. Kennedy Jr., who's running against Biden, has said he supports Bitcoin, and Republicans have sort of taken a pro-Bitcoin stance. But I think it's probably not going to be a huge issue. I just don't see it being like a great way to rally voters, right? I don't think most people care too much unless we're in another bull phase where it's, the talk of the town, but we'll see.
Thanks, my American friend. That was actually very helpful.
Cool. So let's transition over to the Go stablecoin. Let's talk more about some exciting on-chain news, what most of you guys are here for. So Chandler did a lot of research about AAVE's new stablecoin called Go. I'll let you kick things off, Chandler. Where do you want to start?
Yeah, moving over from regulations into something that I think the audience prefers is a deep dive into a new protocol. And I think the latest one that I think will be get quite a lot of press is the new Go stablecoin from AAVE. Very Ghost themed, very cool kind of concept. They announced this about a year ago and have been developing it ever since. What is Go? Go very much and very simply is a stablecoin that directly ties into the AAVE ecosystem. If you think about what other stablecoins are, they're either fully collateralized or kind of centralized or over collateralized from a maker perspective. And what does AAVE have? They have a lot of these collateral tokens that you can use to borrow against. You can borrow any other token, but in the case of where Go fits in, it's their own native token. So an example of where it slightly differs from some of the other protocols is if I have, let's say, 10 ETH and I want to borrow $5,000, I deposit that collateral, that 10 ETH, into the AAVE pools, and I borrow from that pool. In order for me to have borrowed that $5,000, somebody would have had to have deposited that. And the interest rate that governs how much money you earn on your collateral versus how much you pay for any loans is determined by utilization. Now, because Go is actually just a natively minted token, there is no concept of utilization in this, and the collateral that you supply is also going to be backing those tokens. So, as with any other kind of DeFi protocol, it's a fully collateralized token, and you can use it just like you would as any other token. It's got a 1-to-1 peg to $1, with some slight differences to what you would use if you wanted to borrow USDCC. So one of the very particular interesting cases here is because it's not a supplied borrow token, what you as a user will end up doing is paying an interest rate that gets governed by the AAVE governance. So in this case, AAVE, the community, control the interest rates on this one. I have a few kinds of concerns around this issue, mainly just by the fact that governance is slow. And what we've seen in many particular protocols out there is that sometimes they need to be a little bit more fast reacting to some market conditions, maybe particularly a black swan or something that, dried up collateral, or maybe a mispricing in the market. But at the end of the day, I think that what AAVE is going to rely on is more market dynamics to be able to keep that peg. Arbitrageurs will basically be able to try and keep the peg more efficiently than any interest rate changes. So, it's still to be determined what is the best route for the stability of AAVE, but I find that a particularly interesting, different design decision. The other side of that was also because you're not having to pay an interest to someone supplying your collateral, where does all the yield go? Well, in this case, it's going to the AAVE governance DAO and will be controlled by a DAO. So let's say you borrow $10,000, and you pay 500 interest. When you repay your 10,500, you burn the 10,000 that you originally had in circulation, and that 500 will go to the DAO treasury, and the DAO will be able to deploy that in any way, shape, or form that they'll use. But then kind of tying into the last point around kind of the risk parameters here is that AAVE has been around for a while, and this process and this kind of like enhancement is just a feature add in terms of what AAVE has had. And AAVE has had so much Lindy effect for a long time that I feel like, the kind of like robustness of what their actual money markets can provide the industry is really, really valuable. And yeah, I think from a like a use case, I think this is definitely going to be more L2 focused. But yeah, I've got one more thing that I wanted to kind of like talk about when we talk about facilitators and what that means for scaling AAVE. But Justin, what are your first initial thoughts on that?
Yeah, I guess my first question is like, what's their What's the use case of this stablecoin, and like what does the Aave DAO see people using this stablecoin for? Does they see it as a way to get leverage? Like, will people just be selling the Go stablecoin to lever up on ETH when they borrow on Aave? Will they be actually holding it like someone might hold USDC now as a store of value? Will they be putting it into Curve? So I'm curious, like, what Aave is planning for there, if they've even talked about it, or if their thesis is just that we need another decentralized stablecoin. And then I'm also really curious, like, what are their liquidity plans, right? Like, if you borrow all of this Go, let's say you borrow $1 billion of Go or $100 million, or whatever it is, like, how do you exit Go and swap to something like ETH or USDC or cash it out to fiat, right? So where's the liquidity coming from?
Great question. So for the first one, I think we're going to get like a plethora of different stable coins, and it's going to be choose your own adventure from that one. If you love USDC, it's because it's kind of, it's a little bit more secure. They kind of had a run on the bank technically, and are still up and running, versus something like a DAI, which is more decentralized. It might not be as capital efficient, but at the end of the day, you kind of choose the stable coin that fits your preference and needs. And there are many others. So there's I mentioned two. We can also talk about Frax. There's also UST, and there are a couple other versions of this. And Go is just going to be kind of part of that family, moving into it, and it'll be very much up to the Aave team to kind of find that use case and integrate it within the entire ecosystem and spin up new pools. So in terms of its benefits, I think it will have to go toe-to-toe with some of the other stable coins. But where I think it has a distinct advantage, and this ties to your second question, is where does this liquidity come from? The Aave team have kind of developed this concept of a facilitator. And a facilitator just basically boils down to who has the rights to mint Go. Currently, there are going to be only two approved facilitators. This is Aave, and then the other one would be the Flashman team. So those will be the two approved on day one. The vote still needs to go through, but technically, it'll only be the two facilitators. But the interesting case here is anyone can be a facilitator, and once you become a facilitator, you can mint Go according to a predetermined set of rules. Now, each facilitator will have their own sort of like buckets, or like basically like a credit limit that you would have, and this is the only amount of Go that you can then apply. But the mandate that you give to each one of these facilitators is determined by the governance, and it doesn't necessarily have to tie into the Aave ecosystem. So a very interesting use case here is, let's say you're a real world asset provider, you want to be able to have access to the DeFi ecosystem. Instead of having to build out your entire infrastructure, you just have this process which you kind of disclose to the Aave community, saying, all right, we've got these bundle of real world assets, and because we have these assets and they're backed here, we want to have a credit line at Go and with the Aave team, and be able to supply Go to the ecosystem. And anyone then and then anyone on the real world asset side can buy into that, get access to that facility. So it's a much easier onboarding system than actually having to build that entire ecosystem yourselves. You can do under collateralized credit lending, so somebody else takes that risk, and Aave is just the facilitator for that. They kind of use real world assets as an example, but it's basically choose your own, not necessarily choose your own adventure, but it's anyone who wants to be able to have that access into the DeFi ecosystem can go and apply to become one of these facilitators and not have to worry about that tech. And I think that that's a really interesting particular use case that has a lot of potential in the space.
They're really going after Maker in this, right? I mean, this is like a perfect competitor to DAI in some ways, right? So they're really going after that market.
Yeah, I think naturally they would. I think where some of the pitfalls that I personally think Maker had was just around the total use cases that you could have within this ecosystem. And while I still to this day maintain that DAI was one of the greatest DeFi projects that ever started, they never really changed what they could do from that. And what Aave's kind of shown the world is that, yes, you can kind of have a particular use case that you are most known for, but also extend the product out into more interesting use cases. And this I think is an example of that. So yes, they're definitely going to be competing with DAI and make it that entire ecosystem stack, but they're also going to be competing with every other stablecoin provider. I think it's been famously said that the stablecoin problem is the $1 trillion problem to solve, and so a lot of incentive to do this. And what's quite interesting, so the natural benefit here is that if you deposit your collateral into Aave and you mint Go, that collateral still gets used for somebody else's borrow. So you're earning a natural yield against that your underlying collateral, which in effect changes the actual effective interest rate that you'll be paying. So I don't know what the actual interest rates that the AAVE governance will set. That's still to be determined. But I think that they're going to go extremely competitive against what's currently out there. And so I think that'll be a really, really good access to some credit. And if they get enough users in the beginning, it'll be a huge incentive for any sort of DeFi platform to integrate Go within their pools and their markets.
Yeah, so the way I think about it is like, from my understanding now, they're viewing the interest rate as a tool, as they should, and how they've done with like all of AAVE, right? So the interest rate is used to basically push people out of their positions. So like if their collateral is very volatile, like let's say ETH's extremely volatile, similar to how Maker does it actually, they could increase the rate to borrow on the Go stablecoin, basically encouraging more and more people to pay down their debt, lowering the supply of Go, and like making sure that the peg holds. But your thesis is that like the Go interest rate in normal market times, like right now, let's just say, could theoretically be very, very low, like much lower than where you could borrow anywhere else you could borrow. So you could borrow maybe at like 1%, 2%, something like that, you're thinking?
AAVE's kind of mentioned that they used arbitrage for price stability. And what they've said, and what we've also seen, is that arbitrage as a price stability mechanism just does not work in DeFi. It's fundamentally built on a concept of trust, and many times protocols have been trusted. And more philosophically, I believe that any protocol should be able to survive an adversarial natured environment. And if your price stability mechanism is built on trust, it's never going to survive that adversarial side of the market, right? So AAVE do have a arbitrage-based price stability mechanism in normal times. And then where I think that they're going to default to is that in the case that the price stability mechanism through arbitrage breaks, they're going to use the governance tool to be able to start kind of changing some of the more core fundamentals of the market, so that they can kind of make sure that it remains stable. But if I were to kind of be like the go-to market person at AAVE and the person that wants to make Go successful within that ecosystem, I naturally want to make sure that Go has a more attractive starter source of liquidity that people would want to borrow against. And I find that kind of the more rational thing to do is to start off with lower interest rates. I don't see those changing until Go becomes quite systemically large within the ecosystem. And so, yeah, that is my guess. I think they're going to start with low interest rates. It's going to go through the low interest rates. And if, as we said earlier in this call, we started off we're thinking it's a bull cycle. It's going to remain low for the bull cycle. And when we get to the next turn, maybe that's the first time they'll actually have to change those interest rates.
Very interesting. I mean, I think it's going to bring a lot of cool opportunities, right? Like if you can borrow Go at 1%, you can then swap all of that capital you borrowed into the DSR, the DAI savings rate, which is now like 3.5%. Or we're seeing a lot of people bring treasuries on chain, like Ondo Finance, where I used to work, and Robert Leshner's new project is doing the same. So it's going to be very interesting. These like native crypto stablecoins that are, partially algorithmic. This obviously isn't the same model as Frax, but it's like an algorithmic design where borrowing theoretically can be at a very low rate. There's going to be a lot of arbitrage happening where you can just borrow all of that capital cheaply and then, get a higher rate lending it out or utilizing the DAI savings rate or some real world assets. So very interesting times. And yeah, seems like it's been a long time coming, but I really can't wait for it to go live. There hasn't been too much new and innovative stuff happening on chain. So always nice to hear more. Thank you, Chandler. That was awesome. But with that, I think that concludes episode 10. We've been going for about a half an hour now. So thank you guys all so much for watching. Please like and subscribe if you enjoyed the video. That would be very helpful for us. We truly appreciate your support, and we will see you guys on the next one. Bye, everyone.